So we will move on to part 2 on introduction to financial statements. We will start with a question. Can you think of any reasons why a company would deliberately present misleading accounts? Why a company will deliberately, willingly, knowingly present misleading accounts? What is the reason? Just think on that. Now, misleading accounts, that means unfair accounts, accounts which are incorrect, will be presented due to following reasons. The first one, to protect share price, because if share price goes down because of lack of profits, that's not good for the owners and that's not good for the management of the business. So what does the company will do to protect the share price? They will try to increase the profits or may try to show more good financial performance through final accounts, through the accounts. So they will try to mislead the accounts, misrepresent the accounts. Second one, directors and management's rewards are linked to performance and share options. Most of the time, the bonus, the allowance that the managers and the directors are getting is dependent on the profit that is shown in the accounts. So if in a year, if the profits are down, the management try to inflate the accounts, deliberately make misstatements in the accounts in order to show a good picture, in order to show more profit and get more bonus. So they will try to manipulate the accounts for the purpose of getting more performance bonus. Next one, they try to mislead, manipulate financial statements to meet the targets of the business. Then understanding the profits to limit tax. Sorry, understating the profits to limit tax. Sometimes deliberately the management will show a reduced profit in the financial statements to limit the payment of taxation. Next one, legal requirements to meet financial thresholds or financial ratios. Sometimes some legal requirements need you to achieve some benchmarks, profitability ratios, market capitalization. For that, accounts will be manipulated. Or to need to meet the loan covenants. Bankers will put some conditions. So, if in a financial year, the company is not achieving those conditions, the management may try to manipulate the accounts artificially to show that they have achieved those results. So, these are the reasons that a company will mislead the accounts. Then we will move on to the first final account set financial statement, which is known as the statement of financial position. In good old days, this was referred to as the balance sheet. What does this shows? The balance sheet or the statement of financial position shows the financial position of a company, of a business as at a particular given date. Financial position of a business as at a particular given date. Financial position means the position of assets, liabilities and equities of the business. So let's say as at 31st March 2020, what is the position of company's assets, land and buildings, motor vehicles, whatever? What is the position of assets? What is the position of liabilities of the lenders of the business, the bankers and all? What is the outstanding balance of the equity which is infused to the business by the owners? So, statement of financial position consists, we call it balance sheet, consists of the financial position as at a particular date. Generally, you prepare it on 31st March or maybe for 31st December or 30th September. which shows the position of assets, items which are owned by the business, and how it is financed by equity and liability, what is the position as at that date. The balance sheet. The statement of financial position shows the assets, liabilities and capital at a particular point of time, as I told you. So this is the international format of the statement of financial position. It shows the total assets, and how it is financed. Generally, the assets of the business, motor vehicles, land and buildings and everything is financed by the equity shareholder funds as well as by the liabilities, by the borrowings from the bank. So that's the general rule of accounting equation. Can you remember? Assets equals equity plus liability. So assets will be shown on one column, one row, and equity and liability shows in another. So in the statement of financial position, it should be balanced. The value of the assets should be equal to the total of equity and liabilities. These must balance. Once again, I am repeating. In a statement of financial position, the value of the assets should be equal to the total of the equity and liabilities. Same as in the accounting equations, the value of assets should be equal to the equity and liabilities. Now, the balance sheet, which is also known as the statement of financial position, is built up of the already we learned the balance sheet equation, which is, you all know what is it? Assets equals liabilities plus equity. So in your balance sheet format, which we have already looked at, on one side you get the assets. One side you get the assets. Assets are the current assets plus the non-current, the long-term assets. So on one side you get the assets, the other side you will get the liabilities plus the equity. So the formula is assets plus capital plus assets equals capital plus liabilities. So in essence, the balance sheet shows the statement of financial position. In other words, shows the position of assets, liability and equity of the company for a given date. So it shows how the assets of the company are financed by equity and liabilities. Typically, the assets should be financed through capital and liabilities. So it shows assets equals capital plus liabilities. Now, what you are seeing is a sample statement of financial position, a sample balance sheet. Now, I am using both the words, the balance sheet as well as the statement of financial position, for the betterment of you, where if in the exam, whatever the wording that you will receive, you can use that. So a sample statement of financial position is here, sample balance sheet is like this. So if you look at this, as I told you all earlier, this takes the format of the basic balance sheet accounting equation. What is that? Assets equals capital plus equity. Assets equals capital or equity plus liabilities. So you can see the first set of rows, that means the assets. So assets comprise of non-current assets. That means later we will learn once again, that is the assets that you will hold for more than 1 year, freehold land and buildings, furniture, vehicles, things like that, and the current assets. That means assets that will be kept within 1 year. So 320,000 plus 5,000, the total value of assets is 325,000. So as per our balance sheet equation, this should be equal to the total liabilities plus equity. So you can see current liabilities, the total value, trade payables 1000 plus credit card 2000, 3000, and non-current liabilities 222,000, that's the mortgage value, plus the equity 100,000. So the balance sheet is balancing. So the beauty of this particular statement of financial position is, if you have one side balancing to the other, you know it's correct, somewhat correct. That means your double entry accounting system has worked perfectly. What's your double entry accounting system? That means all the transactions have been recorded on the both sides of the accounting equation. That means ultimately the balance sheet, the statement of financial position, should be having the equal value. So from this illustration you can see assets, the value is equaling to the liabilities, and this is the sample statement of financial position. Then once again we are going to current assets. You know what are current assets? Current assets are assets which convert into cash within 1 year. So some examples are inventories, where stocks you will realize within 1 year, trade receivables, your debtors, people who are owing money to you, to the company, investments and prepayments. That's current assets, which is on your assets. And then long-term assets, we call it non-current assets. So these are also known as fixed assets. Assets which will be held for period more than 1 year. There are tangible fixed assets which you can touch, like equipments, motor vehicles, furniture. Intangible assets like goodwill, patents and trademarks, and financial investments like share capital, which will be held for more than 1 year. And then liabilities. In your balance sheet equation, the other side, the liabilities. A liability represents obligation, where the company has to pay. Obligation. Obligation. So liabilities are two types. Current liabilities, that means obligations that you have to settle within 1 year, and non-current liabilities, obligations which you have to pay a period more than 1 year. So current liabilities payable in the short term within a year. So trade creditors, accrued expenditure, tax, bank overdrafts. And non-current liabilities are things which the company has to pay more than 1 year. That means loans, mortgages and debentures. Then equity. Equity is the shareholders or owners' interest in the business. So it can be shareholders' capital, that means the ordinary par value of the shares, and share premium if they have paid more than the par value of the shares, that value. Then accumulated retained profit in the business, which is also the interest, equity of the shareholders, and any other reserve where net worth of the shareholders have gone up. So equity represents shareholder capital, share premium, retained profit and other reserves. So assets should be equal to equity plus liabilities of the business as per the balance sheet equation.